So another issue with the income statement is depreciation. Depreciation is the cost of purchasing non-current assets and does not directly show up on the income statement. So the way that we do that, these assets have value over multiple years, so depreciation reflects an expense for a year of using the non-current asset. This could be based on tax returns. This could be based on how much the equipment or other non-current asset has worn out during the year. It could be based upon its useful life. There's different ways of figuring it. Since we're creating these financial statements more from the point of view of using existing records and backing into what must have happened, we're going to back into it from the balance sheet. On the cost-based balance sheets for non-current assets, the beginning value plus the purchases minus the sales, the book value of those sales, minus depreciation equals the ending value. On cost-based balance sheets, assets are valued at their book value or the original cost less accumulated depreciation. So when they're sold, the account is only decreased by the book value. Any difference between the sales price and the book value would be a gain or loss on the income statement. Doing some algebra, we can solve for depreciation, and we get beginning plus purchases minus sales minus the ending value equals depreciation. So beginning and ending amounts would come from the balance sheet, and then we'd have to have additional information on purchases and sales. So if you can think about your Excel file, these information, the beginning and ending amounts, would have already been entered into the balance sheet, but we would have to have places to enter new numbers for purchases and sales. Land does not depreciate, so it's not included. Raised breeding livestock is valued at a base value and does not depreciate. And so all other non-current assets should be evaluated to find their depreciation. Information about purchases and sales will need to be entered, and I put that information in a table to the side of the non-current assets on the balance sheet. That's where I put them in my Excel file, and I'll show you how to do that when we build the income statement. And I refer to the results from that table on the income statement. And I want to go to some examples to show you really how to do it. So depreciation is figured using the cost value, so we want those cost-based balance sheets. Here I have 2009s and 2010s on the balance sheet, and again these numbers are original cost less accumulated depreciation. So I have the numbers for our purchased breeding livestock and machinery and equipment. During the year, equipment was purchased for $28,000, and this was financed with a trade-in of $7,000. The book value on the machinery was $0, so it had a $0 cost basis, and a loan from the bank. Purchased breeding livestock with no book value was sold for $320, and additional breeding livestock was purchased for $1,100. So down here for our livestock, we can start out with our beginning amount and put that in. Our purchases would be, in this case, $1,100, and our sales, in this case, it was $0 because there was no book value. And so if we didn't have depreciation, we'd take our beginning amount plus what we purchased minus what we got rid of, and that would be $47.83. But our ending amount on the balance sheet is only $3,440. So if you take what it should be minus this ending amount, that gives you your depreciation. Let's do it for the machinery. Machinery is a little bit trickier because we have a trade-in. So our beginning machinery and equipment was the $160,000. Our purchases, here's where we have to think about it. During the year, equipment was purchased for $28,000, and it was financed with a trade-in of $7,000 and a loan from the bank. So you borrowed $21,000 from the bank and gave them equipment for a trade-in value of $7,000, but the book value was $0. So here's where, with a trade-in, you want to include as your purchase the value of what you gave up. And you gave up a $21,000 loan from the bank and a $0 asset, so what you really gave up was only $21,000. The sales was the book value of what you traded in, which was $0. And so in this case, I can just copy that same formula across. We'd have $181,000. But our ending value is actually 153,000. So our depreciation is 28,833. Here, it's important to think about what would be your gain on the income statement. For the purchase breeding livestock, it had zero book value and it was sold. So there was a $320 gain on the income statement from that purchase breeding livestock. Let's make that a little bit bigger so that you can see it. For the machinery and equipment, we had this trade-in. Because it was a trade-in, we don't know if that was truly worth $7,000 or they just marked this up and marked this up, so we don't know. So we don't actually recognize a gain on a trade-in until we actually sell something in an arm's length transaction. Let's do the machinery again, but show you the difference in what it's going to look like with out trade. So this is machinery with no trade. Our beginning amount is still the $160,000. The difference is now that our purchases, because suppose that we sold the old equipment for $7,000, we bought new equipment for $28,000, and they were separate transactions. So we'd actually record $28,000 here as our purchase. Our sales are still zero because the value of what we sold was zero. And so it should be the beginning plus the purchase minus the sales. So if nothing else happened, it should be $188,000. But on the ending balance sheet, it was only worth $153,000. So our depreciation must have been $153,002. The difference is here, though, because we sold that as a separate transaction, we recognize the gain on the income statement. So if you think about this $35,000 minus the $7,000 gain you would show, you're really going to show a net deduction of the same amount, $28,333, on your income statement. So no matter how we account for it, we've still got a $28,000 net change in decreased income on our income statement. The issue is where we're going to put that and how we're going to reflect it on the balance sheet. And so here's how we did it. Going back to our PowerPoint. So now we can talk about coal cows versus gain and loss. This top part of the income statement refers to profit from your production and normal business. Selling non-current assets are not part of your normal business. So gains and losses are included in a section at the end. Coal cow sales are something that would normally happen every single year. So to the extent that they would normally happen every year, it should go on the top part of that income statement in the revenue section. And only if it's something unusual like a herd reduction should it go at the bottom of the income statement. So just what we said, to the extent that coal cow sales are the normal operating procedure, they're included in revenue. And there should be a related accrual adjustment reflecting any increase or decrease in inventory. And then if there's abnormal culling above the normal rates, drought situation, herd reduction, liquidation, then this is included in the gain and loss section.